Hi, in this video, I'm going to talk about the yield to maturity of a bond. So yield to maturity of a bond basically is the internal rate of the return IRR of that bond. So it's the annual return earned on the bonds that is held to maturity. Okay, let's see an example. Say, today, Tom purchased a 5-year bond with a coupon rate of 6% paid semi-annually, and the bond is currently traded in the second market for $1,050. So they give you this information. So basically, what that means, say today, bonds, Tom gonna buy this bonds is at $1,050. So, what he gonna get? He get a series of the cash flow. What's the cash flow? The coupon rate they give you 6%. The par value is $1,000. So, the coupon is paid semi-annually. So you divide it by 2. So you get a coupon payment. Each period is $30. So basically, you will get every 6 months you'll get a $30 coupon payment. Then this is for 5 years is 10. Total is 10 payments. Then at the end of the 5 year, you will get $1,000 the par value of the bonds back. So this basically tell you that's how, when you buy a bond, is you buy a stream of the cash flow. So given all this information, you can calculate, say, what's your yield, what's your real return, annual return for you to receive, those cash flows. So then we can use a financial calculator, then calculate the yield. So basically, when you plug all those numbers in, that will give you 2.43. This is per period. You have to multiply 2. Then you get 4.86%. So here tell you must multiply the periodic rate of the 2.43 by the number of the period per year to arrive at an annual rate. So yeah, that's how you calculate the yield to maturity. Then you probably noticed that you were saying the yield to maturity on Tom's bonds is lower than its coupon rate because the bonds is currently trading at the premium in the second market. Yes, this is a premium bonds. What is a premium bonds is when the bonds is sell at the price is greater than face value, this is called premium bonds. So, when the bonds is selling at a premium, your yield to maturity always less than the coupon rate. Let's see why. Okay, say if you didn't buy the bonds at a higher price, you buy the bonds exactly at the face value, then you are going to get all those cash flow in the future. So then your return is exactly, your maturity is exactly equal to the coupon rate. However, today you buy at a higher price than the par value. So this will give you lower yield to maturity than the coupon rate. That's how you understand this. So this is a premium bonds. How about exactly the same bonds I buy at the market is at $950, which this is less than the par value, which is face value $1,000. So this is called discount bonds. So when you buy discount bonds, given the same information, you can calculate the yield to maturity is 7.21%, which is greater than 6%, which is the coupon rate. So let's think again. Say, if I bought at a par value $1,000, get the same cash flow, I get 6%, yield maturity 6%. How about I buy these bonds at a lower price? Then I get the same cash flow in the future. So my yield to maturity, of course, can be higher than the coupon rate. So that's why this is always true. When you bonds sell at a discount, their yield to maturity is always greater than the coupon rate. When the bonds sell at a premium, so their yield to maturity is less than the coupon rate. So that's just is a fact about the bonds. Okay, so this is the yield to maturity. So basically, when you have this yield, you have an assumption in it. Say reinvestment assumption. All the interest payment on the bonds are reinvested at the calculated yield to maturity. So basically, say, well, every 6 months I get a $30 the coupon. Instead, you take cash, you reinvest this back to the investment at the rate, let's say here is 4.86% at the rate 4.86 annual rate. So then your yield to maturity is true. Okay, so yeah, that's in reality is a little different. Anyway, so that's how you calculate the yield to maturity. So when the yield to maturity is very useful in for you to understand the bonds. So when you hear on the news, they often talk about the government bonds, 10-year bond yield or 30-year bond yield. So they've been quoted on the news medias. So when they quoted the government bonds yield, so here is from the Bloomberg, 30-year government bonds yield is 2.41%. This 2.41% is the yield to maturity.